Welcome. In this video, we'll explore the traditional model of the cost of capital structure, a structured and step-by-step approach. Topic is the cost of capital. The cost of capital is used as a discount rate in NPV calculations. This chapter looks at how the cost of capital is calculated. The cost of capital is the rate of return that the enterprise must pay to satisfy the providers of funds, and it reflects the riskiness of providing funds. Risk-free rate of return. Premium for business risk. Premium for financial risk. Claimant. Creditors with a fixed charge. Creditors with a floating charge. Unsecured creditors. Preference shareholders. Ordinary shareholders. CAPM, Capital Asset Pricing Model, Cost of Debt. Cost of capital if constant dividends paid. Estimating growth rate. Exam formula: G equals BRK underscore E equals D, P underscore 0. Where P underscore 0 is price at time 0, D is dividend, K underscore E is cost of equity or preference capital. Where R is accounting return on capital employed, B is proportion of earnings retained. D underscore 1 equals D underscore 0, 1 plus G, where D underscore 0 is dividend at time 0. D underscore 1 is dividend at time 1. G is dividend growth rate. The Capital Asset Pricing Model, CAPM, can be used to calculate the cost of equity and incorporate risk specific to the company due to variations in can be reduced or market activity eliminated by cannot be diversification diversified away. Increasing risk. Beta less than 1.0. Share less than average risk, K less than average. Beta equals 1.0. Share equals average risk, K equals average. Beta factor, beta, measures the systematic risk of a security relative to the market. It is the average fall in the return on a share each time there is a 1% fall in the stock market as a whole. The CAPM formula. E, RE, equals RF plus beta I, E, RF, exam formula. Where E, RE, is cost of equity capital, expected equity return. RF is risk-free rate of return. E, is return from market. Beta I is beta factor of security. Market risk premium, equity risk premium. E, RF the extra return required from a share to compensate for its risk compared with average market risk. Assumptions unrealistic. Zero insolvency costs. Investment market efficient. Investors hold well-diversified portfolios. Perfect capital market. Required estimates difficult to make. Excess return. Risk-free rate. Government securities rates vary with lending terms. Beta factors difficult to calculate. After-tax cost of a redeemable debt capital. 1T, KD net equals formula to learn. P, 0. Where KD net is the after-tax cost of the debt capital, I is the annual interest payment. P0 is the current market price of the debt capital, X interest, T is the rate of tax. Cost of convertible debt. Use the IRR method as for cost of redeemable debt, but redemption value equals conversion value. Cost of redeemable debt. Year cash flow DFA PVA DFB PVB. 0 market value 1, X, 1, X, 1 N interest less tax XXXXN redemption value XXXX. P0 is current X dividend ordinary share price. G is the expected annual growth of the ordinary share price. VD is market value of debt. Use market values rather than book values unless market values unavailable. Project small relative to company and has same business risk as company. WACC reflects company's long-term future capital structure and costs. New investments financed by new funds. Cost of capital reflects marginal cost. Problems with WACC. New investments may have different business risk. New finance may change capital structure and perceived financial risk. Cost of floating rate capital not easy to calculate.